One area that seems, maybe it's an indirect kind of impact that I didn't hear much about was sort of intersectoral migration between industrial sector, for example, or manufacturing and or even services and agriculture. And one of the hypothesis that I would have is that in these crises, people tend to go back to agriculture out of the more advanced sectors. I think this happened in Indonesia in the 1990s, and so this might kind of bias some of the conclusions that you might have, like Osman was presenting, that agriculture is growing more rapidly or declining less rapidly than the non-agricultural sectors. But that may be partly because of this migration. And if you looked on a per capita basis, what was happening to people in the agricultural sector, they may be getting even worse off because of increased pressure on the land, more land degradation, and just declining prices of non-tradable agricultural commodities. So that's just one thought on that.
Derek is next. Please, colleagues, state your names to our guests.
Derek Hetty, DSG. I think one thing that's also missing, maybe for obvious reasons, is the political linkages. There was a paper by Danny Roderick in 1999 called something like "Where Did All the Growth Go?" And it looked at the shocks of the 1970s and looked at why some countries had suffered so badly and why other countries, particularly in East Asia, kept on growing through these fairly common shocks. And so what might happen is it's a bit like an earthquake. There's an earthquake, some houses stand up, but the very fragile houses crumble. And so maybe especially this is an extra layer onto what John was looking at. Some of these countries are very fragile on your list, like Afghanistan and DRC in particular. So that might be something else to consider, especially for donors, even if it's difficult for research.
Thank you. There were hands up here, right first line.
I'm Bill Liefert with the Economic Research Service of USDA. The financial and economic crisis has to a large degree reversed the big surge in energy and agricultural prices of 2006 to 2008, which most people probably think is a good thing. If it was bad, the prices went up so much. It's probably good they came down. But might it be the case that the economic crisis involves some cost in the long run for at least the problems and issues involving that price surge, just through a kind of a psychological crisis crowding out effect from the point of view, not say of experts like yourselves, but the general public, even policymakers, particularly given that the economic crisis so quickly followed the price surge, and it's a broader-based problem that affects virtually every sector of the economy. In other words, whatever are the long-run causes of that surge in energy and world prices, might it be because of this crisis crowding out effect that certain elements of the public will be less concerned about those problems now than they should be?
Okay, thank you. Shengeng, I come back to you.
Shengeng Fan from IFPRI.
Hey, sorry.
The first
Wait a moment. Yeah. Don't run away with your mic. Shengeng, go on.
I think some updated facts. In fact, some of the new estimates show that the developing country will hit actually much less than you would think. I think Maximo's number is about 3 to 4% growth in developing countries. That probably is an estimation. The new figure for the first quarter shows that India and China will continue to grow at 6 to 8%. So that will actually change the economic balance between developed and developing countries. The first quarter data shows that the recession in rich countries is actually much deeper than we thought. In developing countries, it's much smaller than we thought. So that may change the global balance. The second one is about the regional issue. You have not mentioned about the regional issues within a particular country, big country like China and India. It is some of the booming regions that have suffered a lot. It is some of the lagged regions that actually probably benefited from some of the recession. So we do have some new evidence. So you might try to think the regional implications within a particular country. My last point is about Stephen's remarks about price stickiness in Africa. In fact, the international price transmitted to producers much faster, consumers, urban consumers much faster than producers. So Africa was hit twice. On the one hand, the urban consumers receive much higher prices because most of the food they eat are imported. In the meantime, the producers, because of poor infrastructure, maybe poor services, they continue to receive very low producer prices. So they are hit twice.
Okay, thank you. Two more questions.
Ellen Levinson. I actually have two questions. One is, we didn't really talk about, everyone's saying increase, have to maintain your investment in the social protection and may need increases there due to the impact on certain sectors, as well as maintain and increase investment because obviously there's been lack of investment in growth, infrastructure, et cetera. That sounds very inflationary to me. I don't know where you get that money in a time of lack of economic growth without producing money. So I'd like to hear your comments on that. Where does that money come from for those investments and productive social protection? The second is investment in agriculture. We're all talking about that, and you have up there a variety of things, in infrastructure and research. And then also there was one comment that the small producers obviously are the ones who seem to be hurt the most, blah, blah. But I guess my question is, those types of investment really are long-term, it seems. And I'm just wondering what you think of that, since you all are experts in this area. And also, isn't that also part of experimentation? Aren't we in a state of experimentation right now when we think of sub-Saharan Africa and all these different theories coming out about how to do it, which way? So I'm just wanted to hear your reflections on that, the timeline for that, and the way to invest in that. Thank you.
I know there are more questions out there, but due to time, we need to go back to the panel. Colleagues, don't take more than a minute or two at most. Maximo, you would go first, and you take your pick. Could you also say a few words on the very interesting results which you presented regarding trade financing and what should be done about that?
Okay, on the trade financing, what we have been working with David is, of course, you have to play with sensitivities on the cost of trade financing, but these are basically the costs that you need to cover to be able to move your products and to export them or import them. The issue there, and I think is pretty important to countries where you have higher costs, basically countries with lower infrastructure or with more less capacity to develop the services needed for exports, is how we can develop policies that will help to reduce those so that you can minimize those negative effects. So the policy recommendation there is to prioritize on services which are linked to trade to be able to minimize that effects because, as I show in the graphs, are pretty important. On the investment issue and how to prioritize, I think that something that is clear with the recession is that you will have a significant idle capacity because of the lowering of the manufacturing growth, which in the first quarter was significant. As a result of that, you should expect that some of the costs of production will go down, and especially costs of infrastructure, for example. And you also have the petroleum price, which is at a lower level. That means that for countries like in sub-Saharan Africa or in some Latin American countries where you face tight bottlenecks in terms of access to infrastructure, which is one of the major problems, is easy to prioritize in the sense that you can, if you develop a system of prioritization of investment, it will be easier and cheaper to build a road than what happened before. Now, where the money is coming from, and one of the problems is that there is a credit crunch, as I was explaining before. So the money that used to come through the financial system not necessarily is going to come, and there is where the governments can use some policy to be able to cover that. And given that in some regions you are better than others, then that's where you can reduce that to avoid even in cases of deflation. So I don't see that it will create an inflation. It's basically a substitution in the short term, but that could have a long-term returns.
I will just address that one on the inflation and the social protection investments. I think that for the social protection investment to have inflationary tendencies, they have to reach a certain critical level. I don't see that happening. Moreover, I don't think that you'll have an overall expansion of the expenditures. I think you're going to have some trade-off. Some will be pulled out of investment and going into social protection. So the overall level of expenditure may not be inflationary at the end of the day. What is important, however, is that if you're facing such a growth gap, an investment gap, pulling money out of there to put it into short-term social protection will punish you twice, because you will not be growing up faster to eradicate the problems you're facing in the first place, for which you needed a social protection issue. So I think that what's important and smart is for those social protection expenditures and program to deal with the synergies between social needs and growth needs, and try to find a space where growth stimulation and social protection do overlap. And that's possible depending on the structural conditions of the economies and the sources of growth, the employment generation, and the distribution of the poor people across sectors. You can find that space that allows you to do that.
I'm just going to pick up on the one remark, and that was the issue of the role of governance, and in particular the interface between governance and macro policy. And I think the poster child, as it were, that really illustrates this is the contrast between Chile and Zambia. Governments of both countries are highly reliant on royalties from copper exports. In the case of Chile, the government created a counter-cyclical fund into which a certain portion of mining royalties went. The result being is that when the downturn hit, the government had a ready source of financing to expand social protection and thereby protect the poor part of the Chilean population. By contrast, the Zambian government, it has to be said, got it exactly wrong, which is in effect, as they regarded the boom in copper prices as a permanent rise in price, effectively spent all of it, and now with the downturn don't have the fiscal resources to address the impacts on the poor population in Zambia.
Mm-hmm. Good. Continue.
No, thank you for the questions. I agree of many things that have been said, so I'm going to just talk on about two things. One is the issue of declining prices with the recession and what's going to happen when we get out of the recession. So the main consideration there is what is going to be the medium-term growth for the world economy. And one view is that we are not going to go back to these 15 years of high growth because expansionary monetary policy that we've had over the last 15 years at the global level is not going to happen. So therefore, we should project going forward a growth rate for the world as a whole that is lower than the last 15 years or so. Therefore, there is going to be some downward pressure on prices, but still there may be a crunch time depending on how this plays out. Of course, there is another scenario which says there is so much stimulus in the short run that it's going to happen exactly what happened in the 70s, that you had in the Bonn Summit in 1978. Everybody expanded the aggregate demand. Therefore, you had the price shock again at the end of the 80s, and then you had to have this monetary contraction in 1980s. But I would think that probably if there are no policy mistakes, which of course is a big if, growth should be slower going forward, and therefore prices should not be. We shouldn't have that sort of a price hike because we will not go back to the usual levels, the growth levels that we had before. That's going to have implications for a lot of developing countries because of commodity prices, poverty issues, and so on and so forth. In any case, this is, of course, very debatable. The second thing related to, again, inflationary topics. The question going forward, and I tried to say something in the paper that was published in Maximo's division on global macroeconomic policies and poverty. We have a short-term imbalance. We have two coordination problems. One is the short-term because we have countries with current account surpluses and current account deficits. Now we need aggregate demand expanding in developing countries. Therefore, that may help rebalance the world economy in a way that is non-inflationary. Of course, if the stimulus goes into areas that may already be constrained, they may be facing supply-side constraints, then that's going to have implications. But the fact that we need at the world level to balance these current account deficits and surpluses, and we are expanding aggregate demand in the developing countries through the G20% and some other things, that's good, I think, for a rebalancing of the world economy and shouldn't be that inflationary. Still, we have the other big coordination problem, which is how we manage the energy implications, energy/climate change implications of this imbalances and the growth rate going forward. I just speculate in that paper, but I don't have certainly any projection on that. Thanks.
Steve?
Let me respond to by combining two of the questions I think that didn't get as much comment, and that was John Pender's. I think he's left his question on, are people going back to rural areas or agriculture? Are they the same thing? And then Chang'en's sort of bringing some additional detail that as prices were going up on world markets, they showed up faster in cities in Africa, especially coastal cities, than they did at the farm gate. Are people going back to agriculture? There are a number of countries where the anecdotal evidence is yes, they are. The question is whether they're going back to their rural households where you've got primarily a sort of a social welfare response issue, poor families now having to maintain more members, or are they actually productively going back into agriculture where the concern is that, well, we already have very extensive growth in agriculture. We need more intensive growth because of the environmental problems that extensive growth has. But if it unwinds quickly, you don't really want to do the social compensation through agricultural programs of an emergency nature if those weaken some of your efforts to get longer-term sustainable agricultural growth. For instance, if you were to quickly subsidize fertilizer because you're trying to facilitate lots of young farmers intensifying agriculture, but you're basically displacing a very nascent, emerging private sector delivery of fertilizer, you may get your shorter-term objective, but you are putting the brakes on your longer-term objective. And in a bit that comes back to Chang'en's point, which is that last year we saw we're not sure that we saw much of a supply response. And part of it may be because where you did get the price increase, it was the consumers, not the producers. This year you're on the downside, so the producers are seeing a bit better price, but the problem they're facing is on the input side. And fertilizer prices have come down, but the trade finance has gone up. And so even though the output prices look a bit better for farmers, they're paying a lot more for fertilizer. So you might have gotten a bad supply response or not as much as you wanted last year because of this differential price. And this year you might be getting a not so great supply response because of the trade finance issue coming through input costs.
Well, thank you very much. Let me conclude with pointing at the sense of optimism which I get from this panel regarding length of the recession or depression. It's negative on a worldwide scale. That sense of optimism I don't think is widely shared in all quarters in Europe and the US, but both Usman and Stephen talking about Africa saw a fairly fast recovery, at least that's what I sensed, and for Latin America the range of years presented from Virginia was also much shorter than the average recovery periods estimated from the historic data, which economic history tells us when major economic crises hit, as I presented with the Rogoff, etc. Slide up front. The recovery on employment, however, the panel did not talk much about. Growth comes back much earlier than employment, and employment, especially employment for unskilled labor, is so much more relevant for the poorest of the poor. I think that's a research issue of the different dynamics. Growth coming back, which was very much emphasized here on the panel, yes, but that's only half the story for recovery that reaches the poor. I think there was, both from modeling and from data of the past, a strong consensus that agriculture helps during economic depressions and recessions. It doesn't quite go so deep. I think we need to understand why that is so. I'm sure the panel could argue about that, why that is so. But can we strengthen that? I think that requires a bit more research. In the increasingly volatile world, which our panel also underlined, it is a more volatile, unstable, economically unstable world. The implicit benefit of a stabilization factor for income and employment in the rural economy is an asset. And there were a number of points from the panel, but also from the audience, that the fundamental issue, how much should one really prevent through spending in an economic crisis at the cost of future generations? What is fair, equitable, and efficient? A big debate in this country currently also, of course, applies to China, India, and Africa. And I think we need another seminar on the role of development aid in the context of the financial and economic crisis and behavior of governments, thereby behavior of the donor community and of the developing countries. Thank you all again for coming and for serving on this panel. We look forward to follow up with other sessions. A round of applause for these gentlemen.